Imagine a company that, well, they do everything perfectly.
Right.
I mean, they absolutely knock it out of the park. They crush their revenue goals. They blow right past Wall Street's expectations.
Yeah.
And just for good measure, they actually raise their future guidance because business is booming.
Which is what you want to see.
Exactly. So what happens to their stock? Now, in a logical, rational world, you'd expect it to just shoot straight up.
You would.
But welcome to the real world of AI investing. This exact company does all of that, and their stock immediately drops 8%.
It's wild.
Welcome to today's deep dive, where we're looking at a pretty modern stock market mystery.
It's the kind of scenario that leaves, a lot of people just scratching their heads and frantically refreshing their portfolio apps.
Oh, for sure.
But there actually is a distinct logic to the madness when you peel back the layers of the market psychology here.
And the company we're looking at, the one at the center of this mystery, is CRDO.
Right. Credo Technology Group.
Yeah. Credo Technology Group Holding Ltd. They are this absolute darling in the AI data center connectivity space, and they just experienced this exact bizarre phenomenon.
They did.
But here is our mission for today's deep dive. We are going to look at their massive growth, specifically through the lens of a conservative, long-term investor.
I love that approach.
Because, we're talking about someone who wants to build wealth steadily, safely.
Right. Not a day trader trying to scalp a quick profit on a momentum swing.
Exactly. So we're going to unpack whether this post-earnings drop is a golden buying opportunity or a glaring warning sign to stay far, far away.
Which really is the perfect lens to use right now. Because when you're managing a core conservative portfolio, the rules change entirely.
They really do.
You can't just chase the shiniest new object or the most explosive growth metric. You have to constantly ask yourself, what am I actually paying for?
Right.
And, what are the structural risks embedded in this company's business model?
So let's get right into the numbers. Because on paper, this earnings paradox it's fascinating.
It really is.
We're looking at CRDO's fiscal year 2026 third quarter results. Revenue hit over $407 million.
Which is huge.
Massive. The consensus expectation was sitting around $379 million, so they comfortably cleared that hurdle.
Very comfortably.
And adjusted earnings per share came in at $1.07.
Right.
Easily beating the 89 to 95 cent expectations. And if you look at it year over year, their revenue growth is over 200%.
201.5% to be exact. It's staggering.
Yeah. And quarter over quarter, it jumped nearly 52%. And to top it all off, they raised their Q4 revenue guidance up to the $430 million range. So
why the drop?
Exactly. How on earth does a stock drop 8% on numbers like that?
Because for a conservative investor, it's vital to remember that a stock price isn't just a reflection of what a company earns today. It's a reflection of what the market has already priced in for tomorrow. And with pure play AI stocks right now, the market has priced in absolute, flawless, never-ending perfection.
So hitting a home run isn't enough, because the crowd already bought tickets expecting a grand slam in every single inning.
Precisely. That 8% drop, which, by the way, it actually compounds a broader 32% slide over the last month.
Ouch.
It reflects deep underlying investor anxiety. Wall Street is looking at these numbers and wondering if the growth velocity has peaked.
I see.
When expectations are that sky high, even a spectacular quarter can trigger a sell-off.
Because they think it can't get any better.
Exactly. The institutional money holding the stock starts thinking, well, the growth rate can't realistically accelerate from 200%.
Right.
So I should take my profits off the table before the inevitable deceleration begins.
Okay, that makes the after-hours drop to around $104 make a lot more sense. The market is entirely forward-looking.
It always is.
So to really figure out if this company has a place in a conservative portfolio, we need to understand what we're actually buying.
Yes. Let's look under the hood.
So CRDO operates in the AI data center space, but they aren't building the GPUs.
No, they aren't NVIDIA.
Right. They provide the high-speed nervous system for those data centers. They build things like active electrical cables, optical DSPs, and SerDes IP.
Which sounds like a lot of dense engineering jargon.
It totally does. I want to break this down. What are we actually talking about here?
It's actually quite approachable when you look at the function they serve. Let's take SerDes IP, for example.
Okay.
SerDes stands for serializer, deserializer. Think of it as a highly advanced translator.
A translator.
Yeah. Inside a microchip, Data moves in parallel across many lanes all at once, like a multi-lane highway.
Got it.
But when you need to send that data to another chip across a cable, you can't use a massive, bulky cable with 100 parallel wires. It's just not physically practical.
Right, there's no space for that.
Exactly. So the SerDes takes that parallel data, translates it into a single ultra-fast serial stream, sends it across the wire, and then another SerDes on the other end translates it back into parallel data.
Oh, I see.
It allows vast amounts of AI data to move incredibly fast without taking up too much physical space.
And what about the active electrical cables and optical DSPs?
Similar concepts of just moving data efficiently. Active electrical cables have tiny chips embedded in them to boost the signal over copper wires.
So the data can travel further without degrading.
Exactly. And optical DSPs, digital signal processors, they essentially clean up and process signals that are sent using light over fiber optic cables.
Wow, okay.
In the world of AI, where massive clusters of chips need to talk to each other in microseconds, this plumbing is absolutely critical. If the nervous system lags, the digital brain is useless.
Which perfectly explains why the financials look the way they do, and why analysts initially just fell in love with this business model.
Oh, absolutely.
CRDO has incredibly high operating leverage. Their margins are hitting almost 69%.
68.6, yeah. That is a staggering margin profile.
It really is.
When you have margins that high, every new dollar of revenue disproportionately drops straight to the bottom line as profit.
Because the fixed costs are already covered.
Exactly. And the projections reflect that. By 2026, the expectations are for revenue growth to hit 173%.
Wow.
With earnings per share surging by 301%.
Oh.
From a pure business fundamentals perspective, the engine is absolutely humming.
And they have the fuel to keep it humming, too, because looking at their balance sheet, CRDO is sitting on a massive war chest.
Yes, they are.
The sources note it varies slightly depending on how they account for short-term investments, but we're talking anywhere from over $800 million up to $1.3 billion in cash reserves.
That cash position is a phenomenal defense mechanism, especially right now.
Because money isn't cheap anymore.
Exactly. We are still in an environment where capital is expensive. Having $1 billion in the bank means CRDO can easily fund its own aggressive research and development.
They don't have to go begging to the banks.
Right. They don't need to go to the debt markets or issue new stock and dilute shareholders just to stay ahead of the technology curve.
Which is huge in the semiconductor space.
It's everything. In the fast-paced connectivity space, out-innovating the competition is a matter of pure survival.
So if you look at the analyst ratings based on all this, the optimism is loud and clear. There's a consensus buy rating from 10 different analysts.
Yep.
Their price targets range from $183, which implies a massive 43% upside from current levels, all the way up to $193.
That's very bullish.
It even holds the coveted Zacks #1 strong buy ranking in some of the reports.
It does.
If you're just skimming the headlines, it looks like an absolute no-brainer.
Sure.
But we're looking at this for you, the conservative, long-term investor.
And that changes the math completely.
Exactly. So let's put on the auditor's hat and look at the giant red flags waving in the background here. Because a great company is not always a great stock.
That is the golden rule. And this is where the conversation gets pretty uncomfortable for the momentum investors.
Let's get into it.
Valuation is where conservative investing lives and dies. Let's look at CRDO's price-to-earnings ratio.
The PE ratio.
Right. The industry average for this sector is sitting around a respectable 26 times earnings.
Okay.
CRDO is trading at a staggering 232 times.
Wait, 232?
232.
I know AI carries a premium right now, but how does the market even begin to justify that kind of multiple?
It justifies it by assuming that the 200% growth rate we talked about earlier is going to continue uninterrupted for years.
Which is a massive assumption.
It's a very dangerous assumption. For a conservative investor, paying a 232x PE ratio leaves absolutely zero margin of safety.
Zero room for error.
None. And it doesn't stop there. Their price-to-sales ratio is equally bloated. It's floating anywhere between 28x and 61x, depending on the specific trailing metrics you use.
And what's the industry average for price to sales?
The industry sits around a very normal 7.9 times.
Wow, okay.
Furthermore, their return on equity is an underwhelming 4.95%.
So practically speaking, what does that lack of a margin of safety mean for someone trying to safely grow a retirement account over the next 10 or 20 years?
It means you are walking a tightrope without a net. A conservative investor needs a cushion.
Right.
If the broader market takes a downturn, or if a company with a 26x PE has one slightly mediocre quarter, the stock might dip a bit, but it won't be catastrophic.
But a stock with a 232x PE.
If they miss a single metric, or if guidance is even slightly softer than expected, the stock can fall off a cliff.
Because all that future perfection is already priced in.
Exactly. You are paying an astronomical premium for absolute perfection. And as we just saw with the recent earnings drop, the market will aggressively punish anything less than absolute perfection.
Okay, and speaking of things that are less than perfect, we have to talk about the concentration risk, because this was probably the most shocking detail in all the research we looked at.
It's a big one.
88% of CRDO's revenue comes from just 3 top customers.
Let that sink in.
Let me repeat that. 88%. 3 customers.
This should be terrifying for a conservative investor. You are essentially betting your entire portfolio allocation on the internal purchasing decisions of 3 tech giants.
But those tech giants, presumably companies like Microsoft, Meta, or Google, they're spending billions on AI data centers right now. Isn't that a pretty reliable revenue stream?
It is reliable right up until the exact moment it isn't.
Fair point.
We have to look at the broader market psychology. Right now, those mega-cap companies are facing immense pressure from their own shareholders to show a return on investment for all these AI capital expenditures.
The honeymoon phase is ending.
Exactly. The market is starting to ask Microsoft and Meta, hey, you're spending tens of billions on AI infrastructure, but where is the actual revenue generation from it?
Right. Show us the money.
And if those megacaps decide to optimize their spending, or delay a data center build-out by even 6 months just to appease their shareholders, CRDO's revenue could collapse overnight.
It's like owning a highly successful restaurant, but 88% of your income comes from 3 guys who come in and order the most expensive steak every single night.
That's a great analogy.
If just one of them decides to go on a diet or try the new steakhouse across the street, you suddenly can't make rent.
Exactly. And that brings us to the macro headwinds. The entire AI sector is currently highly reliant on those massive capital expenditures.
Yeah.
If there's a broader economic slowdown, or if supply chain vulnerabilities flare up again, which is always a risk, with semiconductor manufacturing, AI infrastructure spending could easily cool down.
And that creates volatility.
A highly volatile environment.
Mm-hmm.
And high volatility is the exact opposite of what a conservative portfolio is designed to absorb.
Okay, so we've established that while CRDO has a fantastic business model and massive growth, its stock is priced for absolute perfection and carries some terrifying concentrated risks. Yes.
So what are the alternatives? If you're a conservative investor and you see this undeniable massive shift happening with AI data centers, you obviously still want to participate in that growth.
Of course you do. It's a generational shift.
You just don't want to risk losing your shirt on a 232x valuation.
Right.
The research highlights some heavyweights in the space. Broadcom, ticker symbol AVGO, Marvell, ticker MRVL, and a new arrival called Astera Labs, ticker ALB. Let's start with the big one.
Broadcom. Broadcom is the vastly superior alternative for the conservative long-term investor. It is the gold standard for this specific risk profile.
Walk us through why. Because Broadcom isn't exactly a scrappy startup with 200% revenue growth.
No, they aren't. And that maturity is exactly their strength. Broadcom offers deep, stable diversification.
They do a lot more than just AI.
Exactly. They are not a pure-play AI infrastructure bet. They have a massive portfolio of legacy software and semiconductor businesses that act as absolute cash cows.
So they aren't reliant on just 3 customers for 88% of their business, not even close. And they have a much lower, more mature valuation compared to CRDO.
So they have a built-in downside cushion.
Precisely. If AI capital expenditures slow down for a few quarters, Broadcom's legacy businesses keep the lights on and the profits flowing.
That makes sense.
But most importantly, for a long-term conservative strategy, Broadcom pays a dividend.
Oh, right.
You are getting paid a steady stream of income to wait while the broader AI story plays out over the next decade. It offers all the foundational safety nets that CRDO currently lacks.
What about the new kid on the block, Astera Labs? They build PCIe and CXL solutions, which are also absolutely critical for moving data quickly within these AI servers. Could they be a better play?
Astera Labs is growing incredibly fast, and their technology is vital, but a conservative investor should tread very carefully there as well.
Why is that?
Astera suffers from the exact same structural risks as CRDO.
Ah.
They are a newly public company with extreme volatility, a sky-high valuation, and they are a pure-play bet on AI infrastructure.
So buying Astra instead of CRDO is essentially just swapping one high-risk, high-reward profile for another.
Exactly. It doesn't solve the core problem for a conservative portfolio.
Okay, but let's say our listener is a bit stubborn.
It happens.
They understand the risks, they appreciate the safety of Broadcom, but they really want some concentrated exposure to this specific hypergrowth connectivity sector. They just don't want to bet the entire farm on it.
Okay.
There is a specific compromise play outlined in the research.
There is, and it's a very pragmatic strategy for managing risk while still maintaining exposure.
How does it work?
If you absolutely must have exposure to this specific subsector, the recommendation is to build a diversified mix, specifically a 60-40 split.
Okay.
60% allocated to Marvell and 40% allocated to CRDO.
Why use Marvell as the heavy anchor in that scenario?
Because Marvell provides a much-needed balance.
Hmm.
They're deeply entrenched in AI connectivity. In fact, their electro-optics business is booming, but they have a much broader market footing.
Right.
And a significantly more reasonable valuation than CRDO. They have exposure to enterprise networking, carrier infrastructure, and the automotive sectors.
So they're diversified.
Highly diversified.
Hmm.
By anchoring 60% of your specific connectivity allocation in Marvell, you significantly dampen the extreme volatility.
But you still keep that 40% allocation in CRDO to capture the explosive upside if their growth rate actually continues.
Exactly. It is a calculated way to hedge your bets without being totally reckless.
Okay, let's pivot to strategy and timing, because inevitably someone listening is looking at CRDO's after-hours dip to $104 and thinking, this is it.
Buy the dip.
Yeah. The market overreacted to a great earnings report, and this is the discount I've been waiting for. If someone insists on buying, what are the strict rules for portfolio allocation?
The rules are very rigid if you want to protect your capital. If you have a strictly conservative portfolio, meaning wealth preservation is your absolute top priority, and you cannot afford massive drawdowns, CRDO should be completely avoided as a core asset.
Just stay away.
The risk profile simply does not match the investment goal, period.
But what if their portfolio is slightly more growth-oriented? You know, they are still conservative overall, but they have room for a few satellite positions.
In that case, it should be strictly capped at a 5 to 10% allocation within that specific growth bucket.
Okay.
You treat it as a long-term, speculative AI-themed bet. It should never, under any circumstances, form the foundation of your retirement strategy.
And regarding the timing, is this $104 dip the time to finally pull the trigger?
A conservative approach always demands patience. Right now, buying the immediate post-earnings dip is akin to trying to catch a falling knife.
Yeah, it's risky.
The momentum is clearly downward. The prudent advice is to wait. You want to wait for the stock to test the $90 to $100 support line to see if that floor actually holds.
And if it doesn't?
Then it goes lower. Or, honestly, even better, hold off entirely until their Q4 earnings come out around June.
Wait a whole quarter?
Yes. You want to see cold, hard confirmation that the growth story is intact and that their key customers haven't altered their spending plans before you risk your hard-earned capital.
That patience is crucial, especially because the technical and analytical signals we're seeing are completely conflicting right now.
They really are all over the place.
We mentioned earlier that CRDO holds a Zacks #1 strong buy rating in some reports. But if you dig deeper into the exact same source material, they rated a Zacks #3 hold on other metrics.
Which tells you how divided the analysts are.
Yeah. And the technical indicators are just muddy. The RSI is sitting at 33, and the MACD is showing weakness. Let's translate those for a second.
Sure. The RSI, or Relative Strength Index, is a momentum oscillator. It measures the speed and change of price movements.
Okay.
Typically, a stock is considered oversold and due for a bounce when the RSI drops below 30.
And CRDO is at 33.
Right. It's sitting right at 33. So it's in this totally neutral, no man's land territory. It's weak, but not technically weak enough to trigger a classic buy signal.
And the MACD.
The MACD moving average convergence-divergence is another momentum indicator. It shows the relationship between two moving averages of a stock's price.
And what's it saying?
Right now, it's showing weakness, meaning the short-term downward momentum is overpowering the longer-term trend. The model suggests there's only a 60% probability of a short-term bounce.
I don't know about you, but a 60% coin flip isn't exactly the rock-solid foundation I'm looking for.
Exactly. When the analytical signals are conflicting and the technical setup is muddy, the conservative move is always to step back and wait for clarity.
Don't force a trade.
Never. You don't lose money by sitting on the sidelines, but you can certainly lose a substantial amount by jumping into a trade simply because the stock is cheaper today than it was yesterday.
That is fantastic advice. So what does this all mean for you as you review your portfolio? Let's summarize the key takeaways from today's deep dive.
Let's do it.
CRDO is an undeniable powerhouse in the AI data center connectivity space. They have jaw-dropping 200% growth, incredible nearly 69% margins, and a massive billion-dollar pile of cash to fund their own innovation.
The business is strong.
They make the critical plumbing that allows AI data centers to actually function. But their sky-high 232x valuation leaves zero margin of safety.
None.
Furthermore, that extreme customer concentration with 88% of revenue tied to just 3 companies, combined with the intense market volatility surrounding AI capital expenditures, makes it far too risky to be the anchor of a conservative long-term portfolio.
It ultimately comes down to aligning your investments with your actual risk tolerance. High growth is intoxicating to watch.
Oh, it's fun.
But preservation of capital and steady compounding returns are what allow you to sleep soundly at night. If you want a safer harbor that still captures the massive secular wave of AI infrastructure spending, Broadcom is the clear winner.
Well said. But before we go, we want to leave you with one final lingering question to ponder on your own.
Something you want.
Yeah. It builds on everything we've talked about regarding the risks of this space. We know that 88% of CRDO's revenue relies on just 3 massive clients.
Right.
As these mega-cap tech giants look for ways to continuously cut costs in their billion-dollar AI data centers, and as they face pressure to show better margins, what happens to a company like CRDO if just one of those 3 massive clients decides to start designing and building their high-speed connectivity solutions entirely in-house?
That is the multi-billion-dollar question that every conservative investor needs to ask before buying in.
Something to think about next time you check your portfolio. Thanks for joining us on this deep dive.